Hi, everyone. Welcome to Coffee and Conversation with List Self Storage. My name is Allison DeJager, and I'm the president of List. As you may know, List is a platform for buying, selling, and financing self-storage, conversion, and development properties nationwide. If you're not familiar, Coffee and Conversation is a pre-recorded video chat where self-storage professionals can discuss common questions and hiccups they encounter during the acquisition process. Each session focuses on different aspects of buying and selling properties, and they'll be yours to view anytime, anywhere. If you have any questions following the chat, just email them to me, Allison, ALISON, at listselfstorage.com. So today we want to touch on the current state of the market and the direction in which we're headed. We're joined by Ben Vestal of Argus Self Storage Advisors. Hi, Ben.
Hi, thanks for having me.
Yeah, thank you so much for joining. Before we get started, can you tell us just a little bit about yourself and your experience in the industry?
Yeah, I've been in the industry 15 or 16 years. I am the president of Argus Self Storage Advisors. We are a full service investment sales brokerage firm with 26 offices around the country. And I also head up our third party management platform, which currently is operating about 171 assets in 16 different states.
That's great. So we'll just get right into it. Can you describe the performance of self-storage over the last year and how you think 2021 will shape up?
Self-storage was pretty resilient during the pandemic. We actually, at the beginning of the pandemic, we saw, very little move-ins and move-outs. As we went into the summer of 2020, we started to see more move-ins and less move-outs, largely due to the new demand that was created from the work from home and kids, going to school at home. So I think that there was actually an uptick in demand, which has led to, probably a 200 or 300 basis points increase in occupancy across the industry. We also saw, a lot of home remodels and other type of projects that also led to an increase in demand. So we're heading into leasing season here in 2021 at all-time high occupancies. Our portfolio is right around 90%, which is 280 basis points higher than it was last year at this time, and rates seem to be trending in the right direction and moving up.
Oh, that's great news. Have you seen any new construction starts decrease during the pandemic?
We saw some quite a few projects get paused during 2020 where they just approval processes through the local municipalities really came to a screeching halt as they weren't having city council meetings and approvals for a period of time there. We have seen them kind of start to come back, but I do think more so than the pandemic effect, I think, the rising cost and construction costs has really slowed a lot of the new development down there. It's not uncommon for us to talk to developers and they're seeing 25 to 30% overall project increases. So if it was going to be $7 million, it might be $8 or $9 million today, which has a meaningful impact. And rental rates certainly haven't grown at that same pace. So we have seen a lot of projects tabled or pushed off. However, there still is meaningful amounts of new development happening. However, it is down probably 20 or 30% from last year.
Wow, that's crazy. Switching gears just a little bit, what adjustments are you making to operating expenses and revenue when you're valuing a self-storage property today?
With regards to operating expenses, it's pretty standardized these days. One thing that we've seen that's interesting on lease-up deals, we've seen a lot of operators use what I consider outsized marketing budgets. We're seeing 25 to 50 or 60,000 sometimes in lease-up deals in the operating expenses for advertising, and so we've started to peel those back as it seems like leasing activity is increasing. On stabilized deals, we're actually, depending on what the owner is currently spending, we're seeing those, if they're an institutionally operated store and they're stabilized, we're actually able to peel those down and reduce those by 15 or 20%. Obviously everything else is standardized. We have seen an uptick, pretty meaningful uptick in payroll costs. As we came out of the pandemic, it seems like the job market's much tighter and it's harder to hire site managers at a reasonable rate, or what I believe a reasonable rate is. So those are the main adjustments. Obviously, the other one that just has been the elephant in the room for the last 5 to 10 years is real estate taxes. Real estate taxes continue to be one of our largest expense items, and I don't see that slowing down with the amount of debt that we've put on this country and budget shortfalls. So real estate taxes continue to be a major concern and adjustment that we're making when underwriting a value.
Especially with the proposed changes that you just wrote about. That was a great article. So when you're valuing a property, are you using T12, T6, or those year one operating numbers?
So I think that your question is really focused on revenues. That's a really interesting question today. Because we've found that a lot of operators, especially mom and pop operators, really suffered through the pandemic, where the larger operators really stayed flat and improved. They had better technology, more, contactless rentals type thing, and they really didn't skip a beat. So what we're seeing is we're looking at with regards to revenues, depending, we're skinnying it up all the way to a T3 because as we head into the leasing season, the first quarter was tremendously strong on the revenue side, and I think it's going to continue. And so we're looking at a T3 and a year one pro forma valuation typically when looking at value, how revenues are going to perform and how we're valuing it, especially with all-time high occupancies. We're finding that if we take a property to market, it's a 90 to 120 day process, start to finish. So if you think that that's 3 to 4 months, and if we're if we get delayed at all, we're 4 or 5 months into the deal, and that really would complement it, and the owner would really be buying like a T6 at that point, or the new buyer. So we're really looking at year one pro forma numbers with regards to revenue today, with the strong occupancy and strong market fundamentals.
Okay. Yeah, definitely a strong market. I'm actually curious too, have the debt markets played a role in the resiliency of the valuations of self-storage?
I'm sorry, say that again?
Do you think the debt markets have played a role in the resiliency of the valuations for self-storage?
Yes, the debt markets have been very fluid and very open, and has led, the performance of self-storage through the pandemic was very well documented, and it's really the second kind of market disruption that we've had documentation that the self-storage business does well in good times and in bad. And so the debt markets have been open and very fluid, and I do think it has an impact on valuations. However, I think it has less of an impact today than it might have in the past, largely because of the type of capital that's being invested into the space. We're seeing more and more institutional type capitals and ultra high net worth guys investing in the space, and that is, led. It's put the sector in a position where we're less reliant on the debt markets because if you're Blackstone or Bill Gates or a lot of these high net worth guys that have invested, you're not really beholden to the debt markets. You do use debt at some level, but it's okay. It's not a deal killer if you have to put a little bit more equity. And so we're seeing a lot lower leverage transactions on the debt side today, albeit that they are very competitive. I mean, you saw Public Storage acquisition of Easy Storage. I believe they used debt for the first time on that acquisition. And also SmartStop recently, I believe, did a $500 million loan at very compelling rates. So it does have an impact on the values today.
Obviously great news for owners who are considering selling today, but what headwinds do you see on the horizon for self-storage owners?
I think the inflation, inflation can be a friend or a foe, depending on how you look at it. Currently, I think it is helping self-storage owners. So and our business model is set up to react very quickly, which I think will bode very well for self-storage owners. But there is a point where the cost of goods and just the cost of living gets so high that there might be folks that choose not to store because it just doesn't fit in their budget. So I think our customer pool is at risk of shrinking if inflation gets too crazy and the cost of living gets too high. The other thing that's clearly out there is the proposed tax changes of the new administration. I think I identified 11 or 12, proposed tax changes that could have a meaningful impact on a self-storage investment. The capital gains tax, meaningfully going up, the elimination of the 1031 exchange. And if you kind of dig into those, some of those are more estate. We have so many families that are operating family businesses in the self-storage. If they eliminate the step up in basis, I think that could have a tremendous impact on self-storage owners moving forward and just how they position their assets. So, I'm certainly not an accountant, but I would advise everybody to at least get with their accountant and talk to them about how they could have it, what the impact could be of these tax changes. Obviously none of them have been signed into law yet, but it's clear that, with all of the pandemic stimulus, we're going to have massive budget shortfalls in Washington and across this country. So I don't see really any way that taxes are going down. So we're seeing a lot of our savvy investors reposition their portfolios and sell some assets or refinance some assets to make sure that they are protecting their value as much as they can.
Yeah, absolutely. Kind of touching on that a little bit. So if an owner is considering selling in the near term, so let's call it 6 to 12 months, what should they be doing to get their property ready to sell in order to maximize value?
6 to 12 months is a pretty short time frame, but there are things that an owner can do. Certainly, continue with your in-place rental rate increases, especially if you're highly occupied. It's hard to catch up, and so certainly do that. But I also think just basic things like curb appeal, making sure all the deferred maintenance is taken care of. Unequivocally, if we have $5,000 or $10,000 of repairs in asphalt and downspouts, the buyer thinks it's $15,000 or $20,000. So, and it just also puts your best foot forward. The other thing is clean up your financials. Make them simple to understand. The simpler, the better. Us and all advisors in the market can certainly come in and standardize them, but the simpler they are, the better. And also just understand your market. Understand, if there's any new or proposed projects within your trade area, what's the status of them if they've, because unequivocally, if you put your property out there on the market, the buyer is going to underwrite the market as much as they underwrite the individual asset. So if you know that a project's been terminated or shelved because either financing didn't come through or zoning didn't get approved or whatever it may be, the ability to communicate that to the buyer pool is very important in order to maximize your value. And that's really what I would do, in the short term to get your property ready.
I have one more question. With the value of self-storage highly impacted by the stages of real estate cycle, can you give us a feel of where you think we're at in the current cycle?
Sure. So, that's a moving target, right? I think I heard somebody say the other day that we're in extra innings, and I'd probably agree with that. We had, especially in the self-storage space, we're all in the self-storage business, but it's clearly the real estate market that makes us our money. And we're subject to real estate cycles, just like all the other commercial assets, commercial real estate assets. So, I think if I had the best guess, we had one of the longest, or if not the longest, economic expansion leading up to the pandemic. And economic expansions typically don't die of old age; they die of some sort of reason. And this one happened to be a global pandemic that had that kind of changed the way we look at investments. And self-storage came out of it, looking more and more like a core asset and really performing better than all core assets in total candor. And I think that has really pushed us into these extra innings. I think we're very well positioned to have a 2 to 5 year run. If interest rates stay low and development stays under control, and I think it's going to, because not because the demand isn't there, but I think the cost of construction is really going to have a meaningful impact on new development moving forward. And so I think we're probably, I like to use the extra innings, but I think this could be one of the longer games in history. So we've got some runway left, I think.
Yeah. Well, and for the sake of just so everybody, with full disclosure, right now it's May 11th, 2021. So any of these, just take it with a grain of salt.
Yeah, that's a good disclosure then. Awesome.
Did you have anything else you wanted to add before we close out?
Not a lot. I think, I was visiting with Allison before we got on here, and in our 27-year history, I've written a lot of articles, and I honestly don't know how it gets much better than it does today for self-storage owners. The markets such as Denver, Portland, Charlotte, Miami are all digesting their new supply well, and we're starting to see here in Denver, occupancies increase and rental rates. So I really think we're in a very good position to perform well over the next several years. And I think self-storage is going to continue to prove itself as a very reliable income stream. And I think we're going to see more and more institutional equity entering the space in larger deals. So I think it's, self-storage is very well positioned for the next couple of years, I think.
Yeah, I absolutely agree with that. Well, thank you so much, Ben. I really appreciate it.
You bet. Thanks for the opportunity.
Yeah, and thanks everyone for attending this installment of Coffee and Conversation. If you have any questions or comments, just shoot me an email, alison@listselfstorage.com or 248-795-8126. Thanks. Bye.